All right. Hello, everyone. This is Jonathan Thomas, and I'm with Joe Zappia, LVW Advisors, and we are back for the State of the Markets. Today is August 9th, 2022. Let's kick things off, Joe. I know a lot of people are talking these days about recession. Are we in a recession? Let's define it for them and talk about what's going on.
Are we not in a recession? One of the things I would say is that it feels like we're in a bull market of recession worries right now. Using the Google indicator, which is basically just, what keywords are people searching on Google? You can see that recession is at really the highest level ever, even greater than in 2008 and 2009. People are just so worried about recession. This might be the most forecasted and anticipated recession in history, but I'm not really sure we're in one. What do you think?
It doesn't feel like it. I mean, you go shopping, you go out traveling. I mean, airports are crowded as ever. Airplanes are fully booked. It doesn't seem like it's too hard to find a job if you're looking for one. So to me, it doesn't feel like it. You?
Yes. No, but let's look at the data here and really provide some, salient points here for everyone to think about.
Yeah. So this is a chart of leading economic indicators. And so leading economic indicators, for people that don't know, these are things like building permits, manufacturing hours worked. This is supposed to give us some insight into the future of the economy. So it sort of has been a good predictor of recessions, and you can see that it's done so in the last two recessions. And today, while they're still strong, they are somewhat slowing. And I think that's to be expected, just given what the Fed has to do to try to combat inflation. But generally speaking, the leading economic indicators are still pretty strong today.
Yeah, you can see the shaded areas are recessions. So going back to 2000, there's been three recessions, and you can see over each of those periods, the leading indicators turned down pretty aggressively. And while they've maybe rolled over a little bit more recently, they're definitely not in a downtrend.
Right. Yeah, I would agree.
So let's talk about employment. If you look back in history, a deep recession has never really ever happened with employment at the level it's at today. Unemployment is like 3.5%. The most recent jobs report delivered enough new jobs, to the surprise of everybody, that we're actually back to the employment levels pre-COVID. So the economy's back, and there's millions of job openings. So there's just more job openings than there are people to actually do the job. And then we're also actually seeing, some wage growth. So when you put all this together, it doesn't feel very recessionary either. We're not seeing tens of thousands of people being laid off in different industries. So from an employment perspective, no, I don't feel like we're in recession.
Yeah, job openings are way up. Unemployed workers are way down. I'd agree with you. It doesn't feel recessionary at all. Inflation, of course, this is real. Like, we're not going to downplay this, but we think that although inflation has spiked, it's unlikely to remain this elevated for very long. I mean, you're seeing it everywhere. So gas prices not too long ago were $5 a gallon. They've come down in price almost every single day, I think, in the last, month and a half. And now we're down to almost a national average of $4 a gallon. I think that's going to go through the entire economy, and it should hopefully lower prices going forward. Used car prices have fallen off a cliff. I mean, home prices are definitely going down. You're seeing price cut in my neighborhood. There's price cuts everywhere. Houses are going for sale for a lot less than I thought they would have gone for sale just a couple of months ago. So we're seeing parts of this go down for sure.
Yeah, no question. Use the word transitory. The more transitory components of inflation are likely to be the first to roll over. I think the big unknown here is, what's going to happen with other components of inflation, like shelter. You're still seeing rents increasing by double digits, 12, 14% every renewal. So you're still seeing different parts of the economy that definitely inflation pressures are there. The question is, when will they start to back off? But this is, I think the real point here is we have no real idea what's going to happen with inflation. In fact, we'll know a lot more tomorrow when the next report comes out. Mm-hmm. But the key is that it's this uncertainty around inflation and how far the Fed has to go that will determine really when the volatility in the market starts to subside and when some of the uncertainty in markets starts to subside. Because right now it's a real push-pull between the Fed and inflation. How far are they going to go raising rates, and when will inflation finally start to, move back towards that more neutral rate that the Fed's talking about? And nobody really knows the answer.
Right. That's exactly it. Hard to predict this type of stuff.
So I think that one of the big, I was going to, sorry, Jonathan.
I was just going to say,
I think that, the markets have corrected a lot. We show this chart almost every single video that we do, and all the way over to the right, you can see that from the peak in January, this has actually been updated, but from peak to trough, the market corrected about 24% as measured by, percentage change from the high. Many other companies in the index down 40, 50, 60%. So how much of this so-called recession, which we actually aren't seeing yet in most of the indicators, has already been priced into the market? Has the market already become too pessimistic about what's going to happen with the U.S. economy or not? And then, I don't think we know, but we definitely know markets are much more reasonably priced compared to, where they were at the beginning of the year when they were downright expensive.
Yeah, absolutely. That's measured by the PE ratio. You see today it's 15.8 times. The peak earlier this year was over 21, so significantly pulling back. And that's the big reason for that is, corporate earnings, right? So they're continuing to grow.
Yeah, and I think this is kind of key, right? If markets have corrected but earnings are growing, that means markets are getting cheaper. Everybody was really worried about this quarter's earnings. In fact, there was a lot of people out there saying analyst estimates are way too high. Companies are going to miss. Earnings in July and August of this year, right now, are going to be a disaster. And I think about 95% of the companies in the S&P 500 have reported. They reported real sales growth, nominal sales growth, real earnings growth. And we're going to come away, and no one's really talking about it, but this quarter will be the highest quarter of earnings in the history of the S&P 500. Now, it's not a huge growth over the prior quarter, but the point is it didn't contract. So again, everybody's talking about recession. There's one recession indicator that says we're in a technical recession. Jobs market's strong. Leading economic indicators are strong. Corporate earnings are plowing through this just fine, and the markets have corrected. So again, it doesn't really feel like recession right now.
Yeah, I think an important point here is to make the distinction between the stock market and the economy, right? The stock market is not the economy, and the economy is not the stock market. So they don't have to necessarily go hand in hand all the time.
So this is one of the coolest charts I've seen, and this is basically just 70 years of data that shows you a dollar invested in the S&P 500 today is worth $4,100. Think about that. It's unbelievable, the power of compounding, of being invested in the stock market. But you can't get this kind of return if you're not willing to deal with volatility. So this is over the same time period. I'm going to let Jonathan explain this a little bit, but this is over the same time period, and you can see that there's unbelievable levels of volatility from all-time highs over any one period to the peak to trough. You can see that right now the markets are down currently about 14% off their highs as of early August.
Right. So if you just look at that zero line going horizontally across the page, every time that the line is basically on that zero line, that means that stocks are at all-time highs. And anytime it drops below, that's the peak to trough decline from all-time highs going over any period of time. And so, we had periods, right? In the 1970s, the 1980s, there was a pretty long period of time where stocks didn't recover or make all-time highs for quite a long time. And then more recently, in the early 2000s to 2013, give or take. This was the lost decade and a half almost, where, stocks were not trading at all-time highs every day. And like you said, Joe, today we're down about 14%. But, the only thing I would add, going back to this chart, is that we've had 12 recessions since World War II. So imagine that, right? There's 12 time periods in here that we were truly in a recession. And now some of those may have been mild, but a lot of them were pretty severe, where stocks fell about 50%. Yet still, $1 invested then is over 4,000 today.
It's an amazing chart. And actually, I didn't fully understand it until you explained it to me for the first time. So thanks. So The other thing I would say is that stocks are discounting mechanism. Markets are discounting mechanisms. Jonathan, I remember when we did a video coming out of COVID in mid 2020, and you talked about the idea that the news was getting worse with COVID hospitalization and deaths, yet the market was recovering rapidly, up 10%, up 15%, up 20%. It's the same sort of thing now. They don't really ring a bell at the bottom, and markets anticipate the future. And markets, stocks typically bottom before the economy does. And that's what this chart shows you, is that 6 months prior to recession, during a recession, then periods following when an actual recession starts, what markets did looking at actual recessions going all the way back to 1948. And looking out 3 and 5 years, the numbers are unbelievable.
Yeah, no doubt about it. And, the most recent example I can think of was just 2 weeks ago when the Fed came out and they announced they were raising interest rates by 75 basis points. Now, what do you think the market did that day, right? It was up over 2%. Why is that? Well, the market was already down, 23%. And we know that the Fed is pricing or is going to raise interest rates. So the market is pricing that in. So again, the market's up 2% that day. The very next day, the GDP number comes out and we see a negative number again. So now that's 2 quarters in a row, implying a recession to many people. And yet the market was up almost 2% again that day, the very next day. So over that 2-day period, you would think would be terrible news and would have to shatter the markets. You were completely wrong. And we see this time and time again. We saw it with the COVID hospitalizations. We saw it upon the vaccine announcement. When they announced the vaccine, you'd think the market's going to rally. Nope, it actually traded lower that day because it already knew there was going to be a vaccine. So really hard to beat these things and time them. The market's a lot smarter than we think.
Well, it's the wisdom of the crowd, right? So here's another example of that. So this is the worst quarterly returns for the S&P 500 going all the way back to 1926, almost 100 years of data. And you can see that the second quarter of 2022 is about 3/4 of the way down on the page as one of the worst quarters in history for the market, down 16.1%. But again, if you take away the Great Depression, the periods of 1929, 1930, 1931, and you look at the returns 1, 3, 5, and 10 years after these awful quarterly returns, and the returns to the market are pretty awesome. And again, it speaks to the fact that you cannot wait for the news to get positive or for the news to get good in order to make a decision to buy stocks.
Yeah, looking at this chart, I like our odds.
Yeah, and that's a great way to put it. Some of the greatest investors in the world will say that you really just need to handicap things. You need to put a probability on, what the odds are. Let's say that your analysis of a company or the timing of making an investment is going to work in your favor. This is a lot of data, a lot of evidence that really points to the fact that you can't be smarter than the market, and the odds are in your favor when you put money to work after big drawdowns.
Yeah, that's a great point. All right, so what about dividends, Joe?
I love dividends. I love dividends. I love to talk about dividends, but here's something that's pretty amazing. When I saw this chart, it just literally popped off the page. If you go back at the S&P 500 back to 1957, and you just look at how the S&P 500, which is not even a dividend focused market index, it's just a broad exposure of the US economy. Dividends have increased at an average rate of about 5.7% a year, and that's 2% greater than the rate of inflation going all the way back over this 65-year period.
Yeah.
So it's pretty amazing.
It's very powerful. The way I would look at it is the gray line, consider that your cost of living. So that's your grocery bill, that's your rent payment, mortgage, whatever. And the blue line is just the income you're getting, from your dividends of just the S&P 500. And you can see that just the income and the dividends that you're getting from those stocks have outpaced the rate of inflation over time. And if you were to compare this to bonds, it's like night and day, right? Bonds are a fixed rate of interest. Stocks, you're getting that growing income stream. So, they've done well, and, we think that it's going to continue to do well, especially those that, are really growing their dividends rapidly.
Yeah, and I would just add one point to that as we sort of wrap things up. We really believe in focusing on companies that not only pay dividends, but have a focus on maintaining and actually growing that dividend over time. And just the very nature of those sort of companies tend to be really strong businesses, typically with great balance sheets, some sort of competitive mode or advantage around their business. And they're compounders. They're quality companies. You can equate quality companies typically with dividend aristocrats or dividend growth companies, and we think that's a great place to focus today. So, one thing I thought that we would do with this this video would be to wrap things up with a few summary points and give you all some takeaways as to how we're thinking about things. Jonathan and I both feel pretty definitively we are not in a recession. Maybe technically, but most everything that we do every day. I still went to Starbucks the other day and paid $6 for my latte. When I heard we were in recession, I did not postpone that purchase. I don't know, if you did, but so demand restraint is strong. The consumer's in great shape, and U.S. stocks have really powered through earnings. We haven't talked all about international markets. Europe and emerging markets are a whole nother story. But as it relates to U.S. markets, earnings season was great. Companies are powering through this just fine. They have strong balance sheets. But we think a key takeaway here is that the Fed wants to slow the economy down because they want to make sure that this inflationary pressure, whatever it is, does not become entrenched long-term in the economy. So our economy is slowing down fast. We're seeing it in real estate. We're seeing used cars and some of the other things Jonathan mentioned. Financial conditions are tightening as a result. This is all by design. This follow the Fed. The Fed needs to slow things down. You're starting to see it in housing, good, and different asset prices. We're definitely in a bear market. I don't see a lot of great smooth sailing ahead because most bull markets, in short term anyway, have been a result of non-restrictive monetary policy. But the Fed is tight, and they're going to probably continue to raise rates for a while. So we're cautious in that regard, but we want investors to stay focused on the long term. So I guess I would sum up. We don't think you should fight the Fed. We don't think you should be taking excess risk right now, but instead, if you're going to own stocks, focus on quality stocks that pay and increase dividends. We just showed you why. We think that you should have about a year's worth of spending in cash so that you don't need to be a forced seller in the event that volatility continues. We don't think you need to be in a hurry to put a lot of money to work into risk assets because things could remain volatile and difficult for a while. If you haven't done a full review of your portfolio to really understand what kind of risk you're taking, you should. And lastly, if you have a good plan, which we know all of our clients do, and you have a good portfolio, which we also know our clients do, then we really think you should just stay the course.
It's well said, Joe. Absolutely. All right. Well, in summary, if anyone, if you have any questions, or as Joe said, you want to review your portfolio or financial plan, never hesitate to reach out. And thank you all for your feedback to this point, and we appreciate you all as clients.
Yeah, we'll talk to you in a few months.